Let's say you have 10 dozens of books you want to sell. Okay, so you are a seller and you want to sell 10 dozens of books. That means you need buyers to buy that book from you. So you are going to go to where we have enough buyers to offset or sell off that 10 dozens of book to them. Okay, so either you sell the 10 dozens of book to a particular buyer or you sell it to so many buyers at a particular region or particular price point. This is a concept of liquidity. So for you to sell, you have to go to where there is buyer for you to offset that, and for you to buy, you have to go to where there is sellers for you to actually get a deal to go through. This is a very important concept that I want to explain in this very video about liquidity and how you can use it on the 4-hour chart and any other time frame that you can find on your chart right here. So watch this video till the very end. My name is Paradise. On this channel, I discuss everything about Forex day trading strategy to keep you profitable. Please support this channel by leaving a like for this video, subscribe, and turn on the bell notification for more Forex videos like this. Also check the channel for other Forex content. Right here on the usdjpy chart, at this very point where the market is right now, if you notice in my last video right here on the channel, I talked to you guys about the market moving to the upside. Okay, continuation upward to this very area, and that concept was taken from the fact that the market will always find level of liquidity and grab that liquidity before we begin to come back to the downside. If you notice on this chart, something very important happened right here, which I want to explain. And if you notice, market come back to the downside and then move upward, come back right down, and then we have this very little movement to the upside and then aggressive move to the downside again into this very area. Why this area? If you look at history, this very point was a particular point where buyers moved the market to the upside. So what happened here is sellers move the market back down to the zones where buyers are. Okay, collect liquidity from this very price level of 152.63, and then from here a little bit to the downside, collect liquidity from this very area and begin to move the market to the upside. Now, one thing very significant here is when market begin to move to the upside, if you notice, market did not come to this very area because this area is an area of important liquidity right at this very point. So market from here, stay here a little bit and then move upward to grab liquidity from this very point of resistance. Once that liquidity was grabbed and the market was satisfied with that liquidity, market began to come back to the downside. Right now, if you notice where the market is right now, is close to a point of liquidity, which is this very point of 156.80. So this very area is an important liquidity zone right now on the chart. The possible scenario that can happen right here is the market to move this a little bit forward and then grab liquidity from this very area, and then if satisfied, it will begin to come back to the downside for an aggressive move. Now, if the market is not satisfied with this liquidity, it will further push it up again into this very area where we have this little nice drop to the downside. That means market can push upward and then grab this liquidity from this very area and then finally crash back to the downside. The concept here is that market does not move up or down until it is satisfied with liquidity from a particular point. Because think of it as a seller. Let's say, for example, you have 10 dozens of books that you want to sell. You need buyer to buy from you. And if you want to buy 10 dozens of book, you need seller to sell to you. Okay, so this is how the market move. This is how the market move. Once you understand the concept of liquidity, it will be very, very easy for you to trade the markets easily. And what I am expecting right here, like I said in this very video on the channel, is very, very simple. I am expecting the market to move up a little bit. As you can see right here, market is moving upward, and then grab liquidity from here, and then we should see the market come back to the downside. Once we begin to see the market have a failed swing, okay, could not create a new higher than the previous high at this very point, then it is certain that the market is going to begin to move to the downside from here after the creation of a failed swing at this very point. This is exact same thing that happened at this very point right here. Okay, so market move all the way from here upward and then move back down. We did not have a failed swing. Market continue this movement and then grab liquidity before this very drop to the downside. So what you should expect right here, right now, is very, very simple. A movement to the upside to this very area, and then we should see liquidity being grabbed from this very area. Market should come back down, move up again, and have a failed swing. Once you see that failed swing, know that the market is satisfied with the liquidity at this very level and it is ready to move back to the downside. The concept is one of the important way you can identify that the market is satisfied with liquidity from a particular or at a particular point, and the market is failed swing after a grab of liquidity from that very level. This is very, very important. Support this channel by leaving a like for this video, subscribe, and turn on the bell notification for more forex videos like this. Also check the channel for other forex content. If you've not registered with any broker, check the description of this very video. You see a link, and register with my recommended broker in the description of this very video. Thanks for watching.